In the last 24 hours, 3 major developments shook the foundations of the silver market, and a fourth went completely unnoticed by mainstream financial media. By the time this video ends, viewers will understand why silver is moving again, why industrial buyers are paying unprecedented premiums, and why the paper market may no longer control the real price of silver. The US government just confirmed a price floor system for critical minerals, including silver. Hecla Mining revealed numbers that show industrial buyers are bypassing exchanges and paying nearly 30% more for physical silver. APMEX, the largest online precious metals dealer, struggled for a full month to deliver silver due to unprecedented demand. And tens of thousands of in-the-money call options on COMEX silver are poised to potentially overwhelm registered inventories. What happens next could redefine how silver is priced forever. Welcome to A Boring Currency, FX. If you haven't subscribed yet, take a moment. Imagine your wiser self looking back and asking, why didn't I know this sooner? Go ahead, hit subscribe, and tell us in the comments where you're watching from today. For the past weeks, the silver market had been under extraordinary pressure. Prices had crashed from $121 to $64 in a single session, shaking confidence and rattling investors. Yet, beneath the chaos, a structural story was unfolding, one that few were paying attention to. Analysts had observed signals that the paper market no longer reflected reality. Physical demand, government interventions, and industrial requirements were quietly reshaping the market landscape. The first signal came from Washington. Bloomberg reported that the US government had developed a critical minerals price floor system, intended not just for domestic stability, but for a network of allied nations. Jacob Hellberg, Undersecretary of State for Economic Affairs, confirmed that multiple agencies were collaborating on this initiative. The policy would enforce minimum pricing for strategic minerals, including silver, supported by tariffs to maintain market integrity. This announcement was part of a broader initiative. On February 4th, Vice President J.D. Vance addressed representatives from 55 countries at the Critical Minerals Ministerial, emphasizing that reference prices would act as floors at every stage of production. Combined with Project Vault, a $12 billion critical minerals reserve backed by government and private funds, the message was clear. The U.S. would not allow critical mineral prices to collapse, and silver, as a key industrial and strategic metal, was included. The implications for silver holders were immediate. A government-backed price floor essentially guaranteed that the metal would not fall below a certain level within the trading block. For miners, industrial buyers, and investors, this was a tectonic shift. It meant that silver's downside risk was limited by strategic policy rather than market speculation. Meanwhile, Hecla Mining, North America's largest silver producer, released its 2025 full-year results. Revenue exceeded $1.4 billion, up 53% from the previous year, and net income skyrocketed to $321 million, 9 times the previous year. Analysts focused not on the totals, but on the realized silver price. The market average for the quarter was $54.83 per ounce, but Hecla received $69.28 per ounce, a premium of nearly 30%. This extraordinary premium indicated that industrial buyers were no longer relying on COMEX or other exchanges. They were securing supply directly from mines, paying more to guarantee delivery. The logic was simple. For industries dependent on silver, electronics, solar panels, semiconductors, defense systems, paper contracts could not replace the certainty of physical metal. The silver market, in effect, was bifurcating. Paper prices on one side, real physical premiums on the other. These two developments, the price floor and Hecla's premium, set the stage for a silver market increasingly dictated by fundamentals rather than speculative trading. Structural deficits, industrial demand, and strategic policies were converging to redefine what the real price of silver would be. The January crash was no longer a reference point. It was merely a temporary distortion in a market moving toward a new equilibrium. In the shadow of the U.S. government's price floor announcement, one corporate story quietly confirmed a truth that the markets could no longer ignore. Hecla Mining, the largest silver producer in North America, released its full-year 2025 financial results, revealing figures that startled even seasoned analysts. Revenue surpassed $1.4 billion, a 53% increase over the prior year, while net income skyrocketed to $321 million, nearly 9 times higher than 2024. But it was not the headline numbers that mattered most. Buried within the report was the critical detail. Hecla's realized silver price in the fourth quarter averaged $69.28 per ounce, compared to the market benchmark of $54.83, a 30% premium over the quoted market price. This is not a coincidence. It is a signal. It is proof that industrial buyers, those who rely on silver for manufacturing and high-tech production, are bypassing traditional exchanges entirely. They are paying a premium directly to the source, the mines themselves. Hecla's figures confirm that the market price displayed on paper exchanges no longer reflects the true value of silver in real-world terms. The physical market is commanding far higher prices than what speculative trading would suggest. Industry observers point to several factors behind this development. First, global supply constraints. Mining output cannot instantly expand to meet surging demand. Second, institutional and corporate buyers are increasingly wary of relying on exchanges that have historically failed to deliver physical silver promptly. Third, premium contracts and direct sourcing agreements like those executed by multinational corporations are locking in supply for years, reducing the amount of silver available for standard market trading. These dynamics have created a structural divergence between the paper silver price and the real industrial-driven price. Hecla's strategic moves illustrate a broader market reality. The company chose to double down on silver while divesting from other assets, including gold. Its guidance for 2026 projects 15 to 16.5 million ounces of silver production and nearly doubles exploration spending to $55 million. Operational efficiency is remarkable. All-in sustaining costs remain at $18.11 per ounce, while realized prices hover around $69.20. Some mines, like Greens Creek in Alaska, report negative cash costs after byproduct credits. Essentially, Hecla is being paid to mine silver. For analysts, these numbers speak volumes. A mining company cannot consistently realize a 30% premium without a market willing to pay it. This indicates that industrial demand is not just strong, it is strategic. Companies that require silver for technology, defense, and renewable energy applications are actively seeking secure supply channels, even at significantly higher prices. In other words, the premium is a reflection of scarcity, urgency, and the intrinsic value of the metal in industrial processes. The implications extend beyond Hecla. When the largest silver producer in North America achieves such premiums, smaller producers and mining ventures are likely to follow. The entire supply side of the market is being repriced. Investors and industrial buyers now face a new baseline. Silver is worth significantly more than the paper price suggests. Any attempt to suppress prices artificially, whether through paper market manipulation or derivative activity, becomes less effective when physical demand drives premiums at the source. Furthermore, Hecla's results illustrate a pattern that mirrors global trends. In China, physical silver trades at a substantial premium compared to paper contracts. Lease rates in London have spiked historically during periods of high borrowing demand for physical silver. Large corporations like Samsung have secured multi-year contracts directly from mines, bypassing exchanges completely. Hecla's 30% premium confirms that this pattern is now taking hold in North America. Physical silver has emerged as the decisive market driver, with paper markets lagging behind reality. Strategically, this changes the way businesses, investors, and policymakers should view the market. For industrial buyers, securing supply now is not optional. It is a necessity. For investors, holding physical silver provides protection against volatility in paper markets, while also offering exposure to a resource that is increasingly constrained. For policymakers, the divergence between paper and physical prices validates the need for mechanisms like the U.S. price floor. The market is broken in the absence of strategic intervention, and Hecla's premium serves as a clear, quantifiable indicator. In conclusion, Hecla Mining's results are more than corporate earnings. They are a warning and a signal. They confirm that the real value of silver is no longer measured on exchanges alone. The industrial market has asserted itself, creating a pricing environment that is structurally higher than conventional expectations. This is a turning point. Those who ignore the supply-side dynamics risk being blindsided by premiums, shortages, and accelerated price movements. As the silver market adjusts to this new reality, one question dominates the minds of analysts, investors, and industrial planners alike. If the largest producer is achieving a 30% premium, how long before the paper market is forced to catch up? And what will happen when it does? While the U.S. government implemented a price floor and Hecla Mining confirmed the supply-side premium, another story quietly exposed the other half of the silver market problem: demand. In this instance, it was APMEX, the largest online precious metals dealer in the United States, whose recent operational struggles painted a clear picture of a market stretched to its limits. The company had faced a month-long backlog, delayed shipments, and severely reduced inventory, a crisis that affected tens of thousands of buyers nationwide. When APMEX announced that its shipping and service levels had finally returned to normal, it was not merely a logistical update. It was confirmation that the physical silver market had been under extraordinary stress. The CEO's letter revealed the scale of the disruption. During the backlog, orders took 4 additional business days to process, product availability dropped to 21 items in stock, and the workforce had to expand by 25% just to keep up with the unprecedented demand. Weekend order volumes were reported to be 7 times higher than usual. These were not minor fluctuations. They were structural pressure points in the silver market, the kind that exposed weaknesses in supply chains and physical inventory management. For industrial buyers and investors, this was a wake-up call. The market was no longer able to absorb demand spikes efficiently, and any surge in buying activity would immediately create premiums, shortages, and logistical strain. Analysts noted that this backlog coincided with a dramatic price crash. Silver fell from $121 to $64 in a single session. On paper, it might have looked like a collapse that would reduce demand, but in reality, the crash only temporarily suppressed buying pressure. Once prices stabilized and buyers returned, the structural deficits reasserted themselves. The APMEX case demonstrates that the market is cyclical, but increasingly fragile. The inventory drained during the crash did not replenish overnight, and every subsequent wave of buying adds stressed to a system already operating near capacity. This shortage scenario underscores a key point. The paper silver market does not reflect real-world supply constraints. APMEX could not deliver physical metal fast enough, even with decades of operational experience and large warehouses. Delays, reduced inventory, and temporary rationing are not anomalies. They are symptoms of a market where industrial demand and physical shortages dominate price formation. Investors watching the paper market might see price stability or minor fluctuations, but the real market, the physical side, is operating under entirely different dynamics. Furthermore, the situation demonstrates the increasing importance of industrial demand in price formation. Companies that require silver for electronics, semiconductors, solar panels, or defense systems cannot rely solely on exchanges to meet their needs. Direct sourcing, contracts with miners, and paying premiums for guaranteed delivery have become standard practices. This behavior aligns perfectly with Hecla Mining's 30% premium. The industrial buyers who stress-tested the system during the APMEX backlog are the same ones who ensure that physical silver commands a higher price than paper quotes suggest. Strategically, the APMEX shortage has implications beyond operational delays. It reveals a recurring pattern in the silver market. Prices spike, demand overwhelms supply channels, deliveries slow, and exchanges struggle to keep up. When the market recovers, inventory is lower and the structural deficit becomes even more pronounced. Each cycle increases pressure on physical availability, reinforcing premiums and driving market divergence. The crash in January was only a temporary relief, not a resolution. When buying resumes, shortages, premiums, and delays will reappear, often more intense than before. The broader lesson for investors, industrial buyers, and policymakers is clear. The silver market cannot function efficiently without factoring in the physical side of supply and demand. Paper trading, futures contracts, and derivatives are only part of the story. APMEX's struggles are proof that real-world constraints dominate pricing for those who need silver most. The U.S. government's price floor complements this reality by stabilizing minimum prices, but it cannot eliminate the underlying tension between finite physical supply and growing demand. In essence, the APMEX shortage is a structural warning. It shows that industrial buyers are not waiting for paper prices to rise. They are willing to pay premiums, secure supply directly, and bypass traditional exchanges when necessary. For investors, it signals that the real price of silver is higher than quoted, and that any surge in demand will be reflected immediately in physical premiums. For the market as a whole, it marks the beginning of a shift from paper-dominated pricing to a system increasingly determined by tangible scarcity and industrial necessity. As observers digest these developments, the question arises, with supply constrained, demand surging, and the paper market increasingly disconnected from reality, how long before physical shortages drive the next major repricing? And when that moment arrives, who will be prepared to secure real silver, and who will be left facing delays, premiums, and a market that has already moved beyond them? As the market digested the U.S. government's price floor announcement and Hecla Mining's premium confirmation, a fourth and often overlooked factor quietly set the stage for a potential historic move in silver prices: the surge in the money ITM call options. Analysts watching the March 2026 silver futures options identified approximately 35,000 contracts currently in the money. Each contract represents 5,000 ounces of silver, which means that potential delivery demand totals 175 million ounces, well above the 98 million ounces currently registered on COMEX. The discrepancy is not trivial. It represents a situation where the physical market could be stretched beyond its capacity. Even before factoring in industrial demand, premiums, and logistical delays, the significance of this options position is profound. Historically, bullion banks, the major commercial shorts, have used these moments to suppress silver prices before options expiration, attempting to knock as many calls out of the money as possible. On January 30th, they executed this strategy in dramatic fashion, crashing silver from $121 to $64 in a single session. The attempt was intended to eliminate exposure and reduce delivery obligations. Yet, despite the 46% crash, tens of thousands of call options remain ITM. The strategy failed. The banks lost control of price direction, and the physical market is now positioned to assert itself. For industrial buyers, this is critical. Unlike speculative traders, they need physical delivery. Companies like Samsung, which secured multi-year contracts directly from mines, and other industrial buyers are incentivized to exercise their options if it guarantees access to silver. In a market where physical supply is already constrained and premiums are being paid directly to producers, these options become a mechanism for converting financial claims into tangible metal. The result is a feedback loop. Paper market constraints force physical action, which in turn drives further scarcity, premiums, and pricing divergence. The delivery mechanics amplify the urgency. Each exercised option results in a long position in the March silver futures contract. If holders choose to stand for delivery, COMEX must provide physical silver from registered inventories. With only 98 million ounces available against potential demand of 175 million ounces, even partial exercise could create immediate stress on vaults, shipping, and liquidity. Analysts recognize that this is not merely theoretical. Structural deficits, premium pricing, and backlog histories, like the APMEX shortage, demonstrate that the market is already operating at its practical limits. The arrival of options-driven demand may push it beyond a tipping point. This scenario, when combined with Hecla's realized premium, the U.S. government-backed price floor, and structural industrial demand, illustrates a rare alignment of market forces. Supply constraints, strategic interventions, and concentrated demand are converging at a moment when speculative positions are also poised to convert into physical delivery. For the first time in decades, the paper price may no longer suppress the market. Instead, the real, industrial-driven, physically backed price could assert itself fully. Analysts draw parallels to historical cycles, yet emphasize that modern circumstances make this episode unique. In prior decades, market crashes and recoveries were often buffered by inventory surpluses and flexible production. Today, 6-year structural deficits, international supply concentration, and direct industrial sourcing make shortages far more immediate and impactful. When options contracts are exercised, the market cannot print silver. It cannot manufacture 135 years of mining expertise overnight. Physical constraints dominate the outcome. Strategically, the implications extend beyond traders and investors. For policymakers, the alignment validates interventions like the U.S. price floor. For industrial buyers, securing physical silver is no longer optional. It is a requirement to maintain operations. For investors, holding paper contracts without understanding physical supply risk may be perilous. The market is signaling that tangible metal, supply certainty, and premium access are the true drivers of price formation. In conclusion, Part 4 of this unfolding silver story confirms a central thesis. The market has shifted. The paper price is no longer the measure of value. Physical supply, industrial demand, and structural premiums define it. Hecla's 30% premium confirms the supply side, the APMEX shortage confirms the demand side, and the ITM call options show that the paper market itself may be forced to reconcile with reality. The alignment of these factors suggests that a significant price revaluation is not a question of if, but when. The silver market stands at a critical juncture. Structural deficits are deepening, industrial demand is surging, and the mechanisms of delivery are approaching their limits. Any miscalculation by major market participants or delay in supply response could trigger rapid, irreversible price adjustments. The lesson for decision makers is clear. Understanding the interplay of government policy, mining strategy, industrial necessity, and financial instruments is no longer optional. It is essential. The silver market is no longer just a commodity market. It is a strategic, globally significant resource market with consequences that extend far beyond the trading screens. The final question remains, when the paper market can no longer contain physical demand, what will the real price of silver be? And who will be positioned to survive, profit, or lose in the new reality?